Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman & Associates. This is our weekly market update for the week of December 30th. I want to wish everybody a happy new year. I want to thank you for joining us with this episode and all the previous episodes that we've put out so far. As usual, my goal with these episodes are to help use my background in economics to inform you about the economy and financial markets so you can make the wisest, most informed decisions possible. So with that said, let's go ahead and hit the books and get up to speed on the markets. We're going to start off our reflection on last week with some housing data. We saw new home sales and existing home sales both come in higher in November than they were in October. Although housing tends to vary regionally, on the national level, we're seeing an increase in home sales. We're seeing an increase in the stock of available homes for sale, and we're also seeing an increase in the price of housing. The average cost of a new home in the month of November was approximately $485,000. On the economic front, last week we saw the weekly unemployment insurance claims data. Not surprisingly, new or initial claims came in at about 220,000, which is about the same level we've seen over the last few months and pretty close to where we were in 2023. What is surprising and possibly concerning was the continuing claims. Continuing claims are folks that have been on the unemployment insurance program and have not been able to find employment and come off of the program. Those numbers came in at 1.9 million, which is the highest value we've seen since November of 2021. What this data suggests is that although we aren't seeing a high volume of layoffs and workers being put onto the unemployment insurance program, we are seeing workers having a difficult time finding new employment and coming off of the program once they've started. The stock market ended the week with a big sell-off on Friday, but because of the success and the gains earlier in the week, we actually saw all three indices end the week up, with the S&P 500 and the NASDAQ up 1.8%, and the Dow Jones up about 1.5%. One of the hot topics this week in the stock market is what we refer to as the Santa Claus rally. The 7 trading day period following December 24th is typically one of the most reliably and consistently positive periods in the entire calendar year. It also tends to be a good indicator of what the market performance will look like in the month of January. So far this year, the Santa Claus rally in the S&P 500 has not materialized. In fact, the S&P 500 over the last 4 trading days has lost about 1%. So there's still 3 trading days to turn that pattern around and to see positive gains, but it is definitely something that analysts and investors are watching closely right now, and we'll watch throughout the rest of this holiday-shortened trading week. A lot of attention last week was focused on the 10-year Treasury. The yield on the 10-year Treasury is hovering around 4.6% currently, and this is the highest we've seen it since the spring of 2024. It's also very close to the highest we've seen since 2007. The yield on the 10-year Treasury has increased pretty steadily since December 18th, when the FOMC press conference announced that the Federal Reserve believes that there is an ongoing threat of resurgent inflation and that interest rates, in order to combat that inflation, will have to remain higher for longer. Several analysts and economists have now written that they see the increased 10-year Treasury yield as the greatest threat in the short to medium term for the current bull market. 10-year Treasury yields can actually have a significant impact on interest rates for long-term debt, such as mortgage rates or corporate bonds and loans. The 10-year Treasury yield is also used by financial analysts in their discounting and valuation models, and so a significant increase in this yield can actually cause equities to become less attractive. There is a potential that if this 10-year Treasury yield continues to increase, we could see a significant correction in the stock and equities markets as the investors and the investment models recalibrate to this new discount factor. Closing out our update from last week, Bitcoin as well as several other cryptocurrencies have had a pretty rough week. In the shortened trading week, Bitcoin lost about 6.5%. And over the last month, Bitcoin as well as other major cryptocurrencies have seen significant falls. Bitcoin has lost about 2.4% in the last month. Ethereum has lost about 6%. And XRP has lost about 24% in the last 30 days. Several analysts believe that what we're seeing is traders taking advantage of the big post-election gains in cryptocurrency prices to lock in and cash out their profits prior to the end of 2024. Shifting our focus to this week, the stock market will actually close out 2024 and we'll start to finalize all of our fourth quarter and 2024 data. And in fact, up to this point, the NASDAQ has gained about 30% in 2024. The S&P 500 has gained about 25%, and the Dow Jones Industrial Average has gained about 14%. All of these are fantastic performances, but while there's still one more trading day left in 2024, a lot of the analysts and a lot of the focus has shifted to the expectations for January, the first quarter of 2025, as well as 2025 as a whole. This shortened trading week will actually see some manufacturing data released. We'll see some housing data released, specifically the Case-Shiller Home Price Index. And we'll see our regular weekly unemployment insurance claims. Outside of those three areas, it's actually going to be a quiet week for macroeconomic data, as a lot of areas in the country are wrapping up the year and wrapping up the quarter. We also will start to shift our focus to 2025 and what the new year has in store. Looking ahead to the more distant future, our list of points of interest hasn't changed very much from the last 2 weeks. We're, of course, awaiting the changing and transition of administrations from the Biden to Trump administration, as well as the policies and the changes in the first 100 days of this new Trump administration. We're also going to be focused on the fourth quarter and 2024 earnings reports and performance of the underlying assets in the stock market. And last but not least, we'll be focused, at least at the beginning of the year, on all of the January global economic reports that attempt to explain, interpret, and project where the global economy may be in 2025. As I close out this weekly market update, our final one for 2024, I want to thank you for joining me with all these episodes and all these updates. I've definitely enjoyed making these. I hope you've found them enjoyable and informative, and hopefully they've been able to help keep you up to speed on the markets. If you've found them helpful and you'd like to continue to follow us and join us in 2025, don't forget to like and subscribe to the channel. Also, as always, don't forget to take a few minutes, check out some of the other excellent content that we have here on the John G. Ullman page. And don't forget to comment or share your questions in the comments, and I'll do my very best to get back to you. Thank you again for joining me throughout this year. Have a happy new year, and I'll see you in next week's update.